Good morning, good afternoon, and good evening to those of you around the world. Welcome to the daily Trade the Chain crypto update, where we give you everything you need to know for the next 24 hours and hopefully the next few days. Today is Friday, February 3rd, and we are wrapping up the trading week after a big FOMC meeting, as well as non-farm payroll this morning, which is clearly messing with markets, as well as the DXY, which is on our screen. We've been talking about this to start for pretty much most of the sessions that we've been tracking. And of course, we will continue, as it is the reason we are seeing some bearishness across the board today. And not real bearishness, but obviously we're not seeing a mess of green candles, and we are coming off the highs a little bit. DXY is just under the 200 estimated moving average on the 4-hour chart. As you can see here, last time we had basically a swing failure pattern above it and back below into the previous range. Here we are, clearly in the lower range than we were before. But if we confirm and if we break above it and confirm, just to give you a little visual, right here, then assets or risk assets are likely definitely headed lower, probably much more than they are today. If we get rejected off of this, which we did earlier, we did have a bit of a doji here, but obviously prices are clearing up that wick right now and still attacking the 200 moving average. If we fail at the 200 moving average, then we're probably back down to the low of where we traded, on January 25th and 26th, potentially the February 1st low and or lower. So this is still very much at the top of many people's radar, and I think it will continue to be as we get over this hump of data. Basically, the story today was non-farm payrolls, which is tracking new hires in the market, was I think 3x higher than anticipated. Now there's a caveat to that January non-farm payroll numbers can be a little bit wonky because of end of year close and all that fun stuff, but on the other side, that may signal that wage inflation still has a potential issue at hand. If the market's hiring like crazy, unemployment just made a new low. Does that continue to spur demand, which then goes back into rising inflation? Because if your wages are getting higher because the demand market or because the job market's hot, demand will then go into the market because people are making more money, and that will drive up higher prices while we're obviously trying to lower prices. So it's this game of chicken with various assets of the market, or various aspects of the market, I should say, that the Fed is playing. And of course, the market is trying to figure out what way the Fed will interpret this data. So clearly, unemployment going lower and the possibility of wage inflation moving higher is where the market is taking issue right now. But then on the other side is wage inflation has not shown to increase, even though the job market is hot. But on the other side is, now that we're getting a hot job number, will wage inflation increase over Q1, which does not help the Fed's picture on inflation. And of course, we have CPI in about 2 weeks, which will then give us that inflation number. So this is the most recent data we have, along with FOMC, along with earnings that came in yesterday, which were very mixed, but not very negative for the second half of 2023. So we've got conflicting views right now, and that's clearly what the market is pricing in. DXY rose back to the previous range. Equities are still above 4,100. Which is, very important. I believe that this is more or less kind of the bull or bear break point for the continuation, at least in the near term. If we break down, then maybe you're just ranging into CPI, which is, more or less flat markets. We've just got a defined range. Nobody's making real money other than the traders. And then, if we stay above 4,100, then we have, a chance to continue higher, or potentially just range in a high area, which would potentially allow crypto to flourish more as that high beta industry, that high risk industry, gets a little bit of liquidity from maybe a less exciting market such as equities. So thinking about equities in itself right now, the number I wanted to stay above was 4150, which was the previous daily close. This is not the sexiest pattern in the world. Basically, test liquidity low, test liquidity high, back to more or less the same price as where we were last night. And now we are making a decision. So to me, if you you can seep a little bit lower down to 41.20. And if you lose 41.20, then you're at 41.50, which is the coinciding with both supports, which was previously resistance, as well as the VWAP. Now, the issue with this is that you pretty much have a fair value gap here. I think probably the easiest way to do that is right here. So you have this fair value gap. We were looking at this exact same concept, going bullish a couple weeks ago when we were talking about potential bull targets. Now, just because this is here doesn't mean it will be closed, but typically you will see something like this get closed, especially with where price action is headed. So if equities drop below, like I said, 41.20, probably going to close that fair value gap and seep down to 4,100. The resistance level is 40.94, and obviously you have the VWAP at 40.95. So something around this level for a wick would be nice, and then maybe you head higher. So that's really kind of the last defense for the bulls. And of course, if you accept into this range, then you have 40.40 as support, and then you have 39.80 as support, which is obviously where we were trading in for the second half of January heading into February. So those are the targets. And obviously, if you can get back above, if you can stay above 41.20, 41.30, get back above the previous daily close, use that as support, and then you're kind of forming a bull flag to potentially move higher up to 4,200. And of course, if you get above 4,200, then you are, you're on to clearer skies. But, with the way that the dollar's flying, with the way that the market's interpreting, I am less bullish than I was before, but I'm still not ready to say that the bears are in control based on what I've seen. We did see a lot of dip buying from those equities that had mixed earnings yesterday. And obviously crypto is not too far off, and equities are only, how far are we off from the highs? Equities are only a percentage point off the high. So no reason to be, saying the sky is falling, but obviously we're getting a little bit toppy here. And we have to understand, what our targets are for bull and bear. And then, do we range, what's the catapult option to move us higher? Right now, that's basically just the market flushing out some bearish liquidity and then getting back on the same exact narrative that it had Monday and Tuesday, which was, the terminal rate for the federal funds rate is obviously going to be less than 5. Inflation's getting solved. There's $5 trillion on the side of the market that has yet to come in. So, there's your bullish narrative. But then the other people are saying, well, you're pricing in this low terminal rate. You haven't really got, some solid example. You haven't really heard the Fed agree with that, although they've indicated towards it. Plus you have payment issues, or you have payroll issues, meaning, unemployment's moving, lower when we want it to either stay flat or move a little bit higher. And then you also have issues of, the earnings weren't the best. China was closed. China's now open. So do you interpret earnings as being less bad than expected and hopeful for the rest of the year? Or do you call the bluff and say, even though you have more positive expectations for the second half of the year, will you actually achieve those expectations? And that's really where the market's at right now. So you're seeing a lot of bull and bear posturing on either end of the aisle as people decide what the next step of the market's going to be, because we have so much data in front of us. So there's a little bit of explanation as to why we're seeing, this annoying price action, to say the very least. So looking at Bitcoin, we're still hovering around the previous daily close. That's really kind of my magic number. You want to stay above that to have a chance to reattack 23.9 and 24 or higher. If you close above it, then your really last chance of support is 23.3. Else you're seeping back towards this demand zone. And because we're going into the weekend, we might as well discuss the possibility of lower price action. God forbid this demand zone broke. So if the demand zone broke, then you are sitting at 21.3. And then if that level breaks and you're sitting at 20.4, I think you're going to see a lot of liquidity come in around the 20K level. We had this range right here. You had this swing failure pattern lower. You tapped off this level. So, maybe you see something like a dip to 20K, or maybe in the worst case scenario, see a dip to 19 to 20, close this fair value gap, and then move higher. So that's, I don't think we're going to see any, devilish red large candles. And apologies, it looks like I froze a little bit there, so I'm going to restart. I don't see I don't see devilishly large dump candles coming in this weekend. Is it possible if equities close like absolute crap and DXY is just looking extremely strong? Sure, the market could go completely risk off this weekend. I don't think that's likely. We have pumped over the past few weekends. We had a pretty moderate range over the last weekend, with a slight pump into Sunday. But I don't think we're going to start, I don't think we're going to go elevator down just yet. There's not enough data out there to say you should be at recent lows in the near future. Could that happen as we go into Q2, Q3? Sure. But I have a feeling you're going to see some fight around these support levels that I lined out. So looking at Ethereum, bit of a similar picture. It's probably worth checking out ETH BTC too, just because we've been talking about that. Look at where we're closing. ETH BTC looking stronger. Does Bitcoin show weakness and do alts start to show strength? Do we, we've confirmed out of the demand zone. Typically you will end up going back to the top of the channel. So this is, a question for everyone, listening to decide. I may take the trade actually because it's a nice passive trade if it plays out. But long Ethereum, short Bitcoin, equal size trades for expected value. Ethereum goes up, Bitcoin goes down. You're obviously, you may lose a little bit of money, obviously on one end of the trade, but what you're playing is the difference of the value. So if you're longing ETH and you're shorting Bitcoin, maybe you lose. Maybe you make $100 on ETH and you lose $60 on Bitcoin. Well, you just made $40 there for a passive trade, depending on where the market goes. So, or depending on this directional trade of ETH outperforming Bitcoin. So that's how you would do it. You could also take a loan on Bitcoin and buy ETH, but that's obviously a little bit more of a complex strategy. So back to Ethereum, understanding that Ethereum may be outperforming Bitcoin, meaning not going down as fast or going up at a higher rate than Bitcoin. My magic number to stay above is 1650. We obviously do have this previous daily close at 1643. So, the 1643 to 1650, I'd like to see survive. You survive that, you're headed back to 1700 or higher. I have targets all the way up to 1760 right now for the next leg. You lose this level, you're down to 1600, which is, which was resistance for the entirety of the beginning or end of January and beginning of February. And if you lose 1600, then you have 1530 to act as resistance or act as support. And of course, very similar to Bitcoin, if the worst case scenario did happen, we also have 1500 and we also have 1430. That, coincides with a bit of a fair value gap. We also have a fair value gap down to 1340. But again, I don't think you're going to see a whole lot of dumpage absent, a China, Taiwan invasion, or some sort of insane escalation out of the Ukraine-Russia war. There's not a whole lot that I think is just going to wipe all the money off the face of the market immediately right now. There's obviously red herrings, always be aware. I don't think we're just going to plummet down. I think you're still going to see a fight into next week, no matter what. And I think there's still a reason to be a little bit bullish in this market based on how equities are reacting. But that, of course, is contingent on DXY relaxing. If this keeps chatting and moving higher and breaking above the 200 estimated moving average, as well as the previous range, which is 103.4, you're probably not going to have, a glorious time in the market unless you're clicking the short button. So good luck, happy trading, enjoy the weekend. We've had a few crazy weeks, had a lot of pumps. I don't think you'll miss too much by maybe taking a break this weekend, but we do know our levels. We know what to look for, and just be conscious. The casino, so to speak, is open on the weekends for all of the TradeFi guys. So we've seen a lot of pumps over the weekend. We had a more muted weekend last weekend. We did obviously have a small pump into Sunday that was rejected, but once the U.S. markets close, there's only one market that's open, and so that's crypto. So something to be mindful of. especially if you prefer to be risk on or have the outlook that the market is still risk on. So good luck. Happy trading. Speak to everybody on Monday. And if you're not in the Trade the Chain community, you're missing out on a lot of alpha.